Hello, everyone. Welcome to the first ever episode of Asymmetry Investing podcast. Today, I wanted to go over the most important topic, which is asymmetry investing. So, ever since we were very little, we were trained to believe that the higher the risk, the higher the reward you will get, whether that's investing in stocks, in real estate, entrepreneurship, starting businesses. And that's not necessarily true. Um, there is rare instances in the stock market, for instance, that provide asymmetric opportunities where we have very little risk but very high reward. And we also have that vice versa, where we have a high risk and low reward. And we try to avoid those. And when it comes to investing, we want to look at these opportunities where there's a 90% chance probability that the stock doubles in 2 or 3 years, and 10% that goes down only 20%. By stacking, the odds in our favor, we essentially provide a framework where the probability of succeeding is higher than failing, and we can be compensated for that with stock market returns. So essentially, asymmetry is looking for those rare opportunities in the market that if you're knowledgeable enough that you can spot them and investing in them, you have placed yourself in a better statistical probability of succeeding. Um, those opportunities are rare. You have to be knowledgeable enough to spot them and notice them and have conviction in your idea that will come to fruition. One of the most famous asymmetric investors is Warren Buffett. He would always invest in companies where he knew a lot about the situation and there is very little risk but high reward. I don't think he ever invested in a business where the asymmetry was, 50-50, actually symmetric. So ever since we were um, little, we've been trained this way, which is not necessarily true. Where heads I win and tails I don't lose much, right? So looking at investing in that way can probably open your eyes to realize that it is possible to invest to beat the index and get superior returns. It's not easy, but by doing your due diligence and reading a lot about a situation and specializing in certain stocks, you are more likely to succeed than fail. So essentially, we are looking for those opportunities where the asymmetry is in our side. And efficient market theory has essentially taught finance students to believe that the higher the risk, the higher the reward, where the symmetry is equal, 50-50, which is not necessarily true. There are opportunities in the market that if you do your due diligence, that you can get superior returns without taking on additional risk. That's it, guys. This is the first podcast. Thanks for tuning in.